Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boissonou with my co-host Kevin Casey, and today we are joined by Bill Lowman. Good morning, Bill.
Hi, everybody. Good morning.
Good to see your face. My goodness. Okay, kids, just a couple of quick things before we get rolling. First of all, we are, as always, with the Crispin commentary, so make sure you're checking up their lineup as you are going through your week, because the more informed we are, the better off our clients are. Ooh, that could be a tagline. I just made that up.
That's pretty good.
Terrible, right?
But will you remember it?
What? No, God, no, not a chance. I already don't remember it. Just a quick mention. If you are interested, and you should be, in what is going in the land of condos, there is a camp meeting with San Francisco Peninsula Camp, putting it on Thursday. That would be this Thursday, Lake Merced Boathouse, right?
No. Yes,
At
boathouse.
6 p.m.
Like you said, boathouse.
Okay, if you're an LO and you register to go to this thing, it is free. You get dinner and you get information and you get to commune with your colleagues. You don't know that we're your colleagues, but we are. And if you want to bring a realtor, which I highly, highly recommend, you can bring them also for free, if I recall correctly. If you're
Right.
and you did not sponsor this event, you have to pay. Everyone else gets to come and you get to have an evening, and it is of no cost to you. What I will say is, I recently, do you remember when we had Maureen and Tony on for the condo experts, Kevin?
Yes,
And
I do.
I begged them to put together something for realtors to click on so that they could pay $300, I think it is, for this company to review the condo association prior to going on the market. Doesn't that seem like a good idea? For
That sounds like a great idea.
you can find out whether your freaking condo is warrantable or not and have some clue, so it doesn't sit on the market as you get offers in, and then you have to decline them because the people don't qualify, they don't know, blah, blah, blah.
So
Okay.
did they send you a commission check on this, Audrey?
I mean, I'd never, come on, I would never ask for that. You know me. You would, that, not me. Okay, so with that being said, recently I had a HOA take advantage of this little service, and they on their own paid the $300 and are going through this process to find out, like, what is right, what is wrong, what do they need to do to make themselves warrantable, are they on the naughty list for Fannie or not? So anyway, so this camp meeting on Thursday will be great. Again, if you are not getting those notifications,
If
so
you're in San Francisco, come join us. If you're not in San Francisco, come fly out. You can get on Southwest Airlines cheap. You can be here right near the airport, like Uber over, fly home after the show. Yeah, you can do that.
okay, so with all that being said, if you are not in San Francisco, which I am not physically in San Francisco, and neither is Kevin, we have cars and we will drive there. And bridges and tunnels are not scary, so don't be afraid. All right, with that being said, it's a very busy week in the economy. And so this afternoon, we have a bond auction at, I believe, 1 o'clock. I don't know. It was today. All right, 20-year bond auction. It can move the market, so keep it alert. Tomorrow, the Fed is wrapping up their meeting. We are expecting them to pause again and not go up or down on the rates. What we are interested in is, what does Uncle Jerome have to say, and what are they going to do with the balance sheet? Are they going to allow runoff? Are they going to reinvest? What are they going to do? That is going to really impact the market. And then on Thursday, we have existing home sales, and we had CPI and PPI last week, our inflation reports. Next, PCE, which is the Fed's favorite measure of inflation, is March 28th. So buckle up, kiddies. There's always something going on, and it'll be interesting to see what they have to say tomorrow and how they're feeling about the state of affairs. So with that, Bill, I have been trying for a couple weeks, ever since I heard Jerome Powell state in some comments that not to worry, that the tariffs are just a one-time hit to the economy, and they don't think it will make a
I
huge.
think he called it transitory.
Okay, don't use the T word.
Kind of like that transitory thing with COVID, as I recall, that we're still fighting over. But okay.
That was all bad. Remember that? It was not only, it was false. It was
So
not.
apparently tariffs are transitory also.
Well, TT, transitory tariffs. You know what? Fair enough, Kevin, because they don't always get it right. So we will see later. But in the short term, we are left to guess, hopefully an educated guess, about what is going to happen. So I called our favorite, well, I have to be careful here, our favorite economist, Dr. Elliot Eisenberg, who is out of the country and still made sure that he got back to me, which we so appreciate. And he agreed that
What's he, wait, what's he doing in Russia?
he's not in Russia, but thank you for thank you for your input. Okay, so he did agree, and the way he explained it is if you're buying a chaise lounge, I don't know why that word was used in particular, and it used to be $100 and now it's $125. Okay, that's a one-time thing, and it won't go up again, presumably. But also there are all sorts of other factors that go into this whole idea of what it will cost. Things like people adjusting their supply chains. Where am I going to get where will I get my raw materials from? Am I going to get them from different places? What happens with monetary policy? Bill, do you want to chime in with any other brilliant ideas on how this trickles down?
Well, sure. So, going back, Audrey, to the Fed meeting tomorrow, and I think, everybody knows that there's going to be a pause. And I think the most interesting thing that is going to come out of that is probably the fight that President Trump will then pick with Powell and what the impact of that fight is going to be, because I think we all know the president would like to control interest rates.
Well, he said he knows more about it than Powell does.
Yeah, and we've made a suggestion to the administration that they can certainly control interest rates by reducing the MIP on FHA loans. That's a good way to control interest rate. You control that level.
Same with loan level pricing on Fredie.
And so I think that's really going to be the interesting thing. And, will that fight create more volatility that will potentially, have the Fed continuing to pause, because the pauses are because of the volatility. So I'm interested in the fight. I think we all know the decision. And, of course, Elliot is right on the one-time impact of inflation. The chaise lounge example is perfect, really. I mean, in my mind, I think of it as if all the tariffs are put into place across the board and inflation goes from 3% to 3.1%, and those tariffs don't move anymore, it's going to stay at 3.1%. I think the crazy thing for our markets right now is, oh, it's a 50% tariff. Oh, I'm pissed off at you. Now it's 200%. And, that's kind of where the devil lies in tariffs and its impact on inflation and on our economy.
I'm glad you said that, because that actually was something that Dr. Eisenberg had to say, which was if it gets into some sort of, tit for tat, or, oh, you said that, so now I'm going to do this, and the tariffs keep escalating, then obviously that changes the equation, that changes the whole. So thank you. That is.
So in other words, if your Shea Lounge goes up by $25 and you can choose not to buy one now or buy another one somewhere else or source it from a different place, that doesn't inflect inflation. However, if the Shea Lounge goes up by $25, but so does your gallon of gas and your quart of milk and your eggs and your everything else, then you got a problem.
Well, the other thing too to remember is that when we're comparing inflation numbers, we're doing them year over year, typically. Monthly inflation bump, but then we're replacing numbers from last year with this year's numbers, right? So at some point, this bump it goes away from the equation. And so it's complicated, but it's simple all at the same time, but mostly complicated. And bottom line is we can't control any of this. It's just happening. And I'm reading news articles about the response from Canada and what is happening up there with people they're not buying US products now if they can help it. And then the people here who supply them, who have nothing to do with this fight at all, they are not, and then their businesses are really being hurt. And so it's it's going to be interesting to see how this all plays out. And we are early in the game for sure. We a couple weeks ago, it was very quickly pointed out that we are seeing immediate impacts to the economy as we're watching the GDP estimates out of the Atlanta Fed just go from being positive to being quite negative in a very short amount of time. I think we had almost a 5-point swing in less than 2 weeks. And again, when the Fed meets and they're looking at all these things, it'll be interesting to see what their take is on all that and how they plan to deal with it. I just always like to remember that Jerome Powell was originally appointed by President Trump in his first presidency. Then he was kept on by Joe Biden, and then he has a contract. They can't get rid of him.
He's only got a year left.
So he's in this and he's not going anywhere. He's said it very bluntly. So it'll be interesting to see how it plays out. And I think most of us can agree that monetary policy should be separate from any other part of the government and anyone else's influence. So hang on, kid.
So the original forecast for this year was that there were going to be 2 Fed cuts this year. And then a few weeks ago, it suddenly changed to 3 Fed cuts. But now it seems like there may be no Fed cuts.
So originally it was going to be 4. That was like before all this. And then it went down to 2, and now it's up, and I think to more like 3 is what they're estimating. But again, I don't know how anyone is making projections and thinking that they're going to have any idea. I mean, you don't know what's happening at 3 o'clock today, let alone, in 6 months.
Yeah. Audrey, that, and Kevin, that, Atlanta GBT, GDP number, this is also confusing and it all gives me a headache. Just even historically has been a volatile number going positive to negative, although there is a negative trend. And if that negative trend continues, and maybe I just have my head in the sand because that's where I'm most comfortable. But I through that, the release of that number, I heard a new word. That if that number continues negative, the fear is it is going to be a Trump session, which is a recession caused by Trump policy.
Oh, geez, Louise.
And I've never heard that before. And by the way, I'm not for, against anything. It's just kind of fascinating, all the stuff that you hear. And that is a new term that is starting to be circulated.
Well, okay. And we try and keep it as close to the middle
Oh,
as
for sure.
And so, and because there are 2 sides to everything, and it is not, I would just like to remember that recessions are very cyclical and we are due, right? So regardless of what they're up to, we were kind of.
Why are we due?
Because they're cyclical. They happen oh my God, I'm going to beat you. Okay.
No, because the economy's run so hot, right? It's got to cool off. And, the bad news is there's a recession. The good news is it's probably good for interest rates. The bad news is, delinquencies rise. So.
Right.
Yeah, potentially. But again, when we have an average LTV in this country of 46, 47%, I mean, there is no forecast that we're going to have some horrible crash. And we talked about this last week that, again, recessions are good for the mortgage industry and for real estate. They just are, unless we cause them, of course, like we did. Not meaning us.
I thought it was just you, Audrey.
Don't get me started, Kevin. Okay. So anyway, with all that being said, we're in for a ride, but in the meantime, we focus on how do we help our clients? How do we help them make decisions? If we know that housing is strong and we expect it to remain strong, and who the heck knows what's going on with interest rates, but regardless of what's going on with interest rates, the values are going up and they expect them to continue to go up. So there you go. There you go. With that being said, Peter said, MIP and LLPA's control influence rate on mortgages. Isn't he more interested in controlling the Fed rate since it's broader and more geared towards business and not the end consumer? And so I agree. I would love to see nobody talks about the LLPAs these days, which is driving me crazy because again, the MIP, we learned from FHA quite some time ago impacts so few people. It's not even funny. The number of people who keep their FHA loan for anything more than a few years is low. So that's not a big impact, but those LLPAs are hitting every single person who is doing a transaction through Fannie and Freddie. And so that is a big issue that we've got to watch.
Audrey and Kevin, why the MIP comes up is because right now the reserve level is 5 times the statutory requirement. So why are consumers being charged more when the statutory requirement is being exceeded by 5x?
I get it. I get it. Don't you think
Yeah.
Doge should go in there and handle all that?
Don't bait me. Don't bait me.
Well, I'm thinking maybe they're thinking that they might need that 5 times.
Well, okay, so again, we had this explained to us directly from FHA as well, where they were saying that the way that they do their projections, that they're, they're always looking forward, not backwards. And so are we going to need that money is what their concern is. And weren't there, the last time I looked at FHA delinquency rates, they were like, what, 11% or something? They were not low. And so there was some concern around that. So there you go. No? Yeah. Okay.
No, look, I think you can reduce it lower, to 3 times the amount, still protect the fund and not charge consumers when they shouldn't be charged.
I agree. Well, the same could be said actually for our US. Okay, so I was gonna save this because we have Dr. Selma Hepp, who's the chief economist for CoreLogic. She's coming in a few weeks, and I was gonna save it for her because they were talking. I heard a conversation about the amount of money that the US Treasury has, and normally it's like $300 billion. Now it's 600 billion or trillion, or who knows? I got to go back and look at my notes, but bottom line is we have a whole lot more money than we normally did historically. And maybe we don't need to sell as many treasuries, and maybe we don't need, so anyway, we're going to take a dive into that in the next few weeks, just because I thought that was really interesting. I didn't know that at all.
What
So,
if we just bought our own treasuries?
and Michael made the comment, 2 to 3 Fed cuts are priced in the futures for this year at the moment. So we'll see. I mean, as we know, that can change on a dime.
Mhm.
Absolutely, right? So, all right. With that
We
being,
can go to war with Iran.
yeah.
Or no, that was a headline 20 minutes ago. Sorry.
I know one day I was looking at, I think it was Bloomberg, and they had a timeline for the day, and at 10 o'clock, this happened, and at 10:15, this happened, at 11:45, this happened. I'm like, OMG. I know a number of people who are like, I'm only going to watch the news on Mondays and Fridays. Like,
Let's brighten this thing up, can we?
what?
I think we can.
Exactly.
Hey, I'm noticing home values are jumping suddenly.
Thank you.
That?
Thank you for your input. Appreciate it. Yeah, so okay, you know what? Everything is a little dark. Everything I have written down, it's all a little dark, except for our Treasury Secretary, Scott Bessent, who is sunshine and roses. So let's talk about him for a moment, because again, this is a guy, smart, runs, does he still run his hedge fund? Runs a very successful business and uses more mortgage words than any Treasury Secretary that we've ever heard from, and seems to know his stuff, right? So he is very, very optimistic about what's going on. But he has also said, give us a minute. We just got going on this. So you can't really hold them to account for, 9 to 12 months. What do you think about that, Bill?
Well, I agree with you on what you said about the Treasury Secretary Bessent, and I think where one of the ways this really impacts all of us is for Fannie and Freddie to come out of conservatorship. It requires a heavy lift from Treasury, and so you see the tweets and the things coming out of the new FHFA director about his comments on Fannie and Freddie, and that might make you think, oh, he's going to start moving too fast. you still have the lift from Treasury that needs to occur. And as you quoted him saying, what was his quote saying? You got to give us a little time here to get, our feet under us and doing that. So that, to me, when you look at the totality of Treasury and FHFA, Secretary Bessent's the adult in the room.
Yeah, again,
And what do
you so far, so, yeah.
by a lift from Treasury, what kind of lift are you looking for? You need some, like, an extra hand, or, like, do we need like 20 guys come over and help lift this? Like, what's the scale here of the lift?
It's a lot. It is a lot. Sorry about that. That was Secretary Bessent calling. He told me not to say anything about the work they have to do behind the scenes, Kevin. So I'm going to be gagged on that.
All right.
But it requires a lot from Treasury, according to the PSPAs, to get Fannie and Freddie out of conservatorship. So one of the reasons why it was perhaps thought this wouldn't even come to fruition, at least in the first 2 or 3 years, is that Treasury is going to be spending a lot of time over the next year or two on the Trump tax bill and the work that's going to be needed to get that done. So, again, all we and what we're working on at the NBA is, everybody, I think, supports the fact that Fannie and Freddie should come out of conservatorship, but it needs to be done in an orderly fashion. And there's 3 or 4 things that, we feel must occur for that to ensure liquidity and not be disruptive to housing.
I think too, though, when we start talking about them coming out of conservatorship, first of all, I thought it was really interesting last night when I read that the new head of the FHFA, Pulte, he has completely thrown the boards for Fannie Mae and Freddie Mac up in the air and gotten rid of a whole bunch of people, brought in a bunch of people who, like one guy is a security engineer at SpaceX. And I mean, he's now on, I don't know whether he's on Fannie or Freddie's. Oh, he's on Fannie's board. I mean, interesting choices. I'm not sure what a qualification being a security engineer at SpaceX would give you so that you'd be an asset to the Fannie board. So knowing now that we have people in there who may or may not understand even the business.
Yeah, have you ever been on the board before and you bring in a bunch of new people, they always try everything that's already been tried before until they get educated on, no, that's been done, that doesn't work. Well, that's been done, that doesn't work. This is what we're working on, and this is what's been working, and this is where we're going. Usually, I've been on many a board, and that's kind of how the conversation goes. But you have a lot of a shakeup when the people first come in there, and they're like, they think they know what they're doing, and they don't. And
Right.
it isn't until they get kind of like, oh, now I understand. Oh, wait, you were correct in what you were doing, but let's continue that. But let's try this little tweak, and then that's when you start seeing the changes. That's just a general board comment.
Yeah, I'm on a committee and I just saw something recently, the same thing. This guy comes in, he's all, full of ideas and all this.
Full of ideas, gung ho. I'm like, yeah, we've tried all those ideas.
It takes a while to kind of unwind that and realize, oops, okay, that doesn't actually, we've tried that. That absolutely doesn't work, whatever, right?
Yep.
With that being said, this should come as no surprise. The only, I mean, at this point, because that's not how this is, the last 2 months have gone, right? So my favorite headline of the week was volatility making it difficult to predict Fed moves. I mean, talk about a massive understatement, right? So volatility is not a friend of the markets. It's not what the markets like. And so when they don't know what to expect, and none of us know what to expect at this point, it'll be interesting. But every estimate for the GSEs coming out of conservatorship, or there's no way it's happening this year. It may not happen next year, and who knows, because it's so complicated. It's so complicated. It's not some simple thing that just happens overnight. And then the other part of it is everyone seems to agree, oh yeah, it should happen, but the rates are, it seems like there's a pretty fair consensus that rates are going to go up to the consumer. Okay, so who does that benefit? I mean, we have all just become too, in my opinion, so hyper-focused on money, the bottom line of every organization. How much profit is everyone making? How many private jets can any organization afford so that their, owners or CEOs can fly to dinner with their buddies? I mean, it is the consumer who pays for all of this. And so at what point do we ever get back to what is good for the consumer in all of this? Bill?
What's good for the consumer, or what would mitigate that from occurring with Fannie and Freddie coming out of conservatorship, which is probably, the one thing that as an industry would need to be our hill to die on, is that the explicit government guarantee stays in place. And then investors downstream have the confidence to continue to buy, the mortgage-backed securities. And that, I think, mitigates that. And I think it's going to be a tug of war, but that is where I think the rubber is going to meet the road. And that is the hill for our industry to die on. Otherwise, what you said would exactly happen.
Well, so I listened to 2 sessions with Mark Calabria, and the takeaway, and this was just prior to, in the months leading up to January 20th. So before all these sweeping changes had started happening, he had said there's no guarantee. I mean, and implicit, explicit, you just said explicit. I mean, there's no government guarantee, and there's a misunderstanding around that concept. And I am not schooled enough on this to be able to speak to it much beyond this, but I thought that is very interesting, because there's this thought that the government backs the GSEs, and they certainly have, as we've seen in the past, but it doesn't sound like it's a given, and that is something that would automatically be carried forward. So what are your thoughts on that?
Well, I think, first of all, I don't think Calabria's agenda has changed.
Right.
And so these are the things that he was saying when he was trying to ramrod the agencies out of conservatorship. So I think everything with him is a grain of salt. And, from my perspective, I don't think it matters whether Dr. Calabria thinks this is a valid, explicit guarantee from the government of the United States. I think what matters is the investors that buy these loans downstream have the confidence to continue to buy them, so it doesn't impact that. And so, next time he says that, say, it doesn't matter what you think, Dr. Calabria, it matters what the investors around the world think.
Yeah.
So I think that the question is, going forward, will the investors believe that there is some sort of guarantee?
Yeah. And I disagree with him, and I am not an expert, don't get me wrong. But, I think when you talk to people within the industry, everybody is convinced that there's 3 or 4 things that, must happen. One is the explicit guarantee. The second thing is a level playing field. Don't go back to, the earlier days where, Rocket and UWM and some of the big guys get better deals than the mom and pop mortgage bank on the corner, that it is a level playing field. Because if the playing field becomes unlevel, it's just going to slant all the business and really harm the mom and pop lenders on the corner. That's one. And the third one, is, from time to time, you got to keep Fannie and Freddie out of the primary market. They're a secondary market provider. They provide liquidity. There's a bright line, stay out of the primary markets.
So is that the case now? Is that, so does everyone get the same pricing? Everyone gets it?
I'm going to use the word allegedly. Do I Do I, so the G fees are level, yeah, allegedly.
Allegedly.
I've always been like, so I'm gonna stop talking, but allegedly.
Don't stop talking right when we want to hear what you have to say.
And that's a good piece of information.
Yeah.
Allegedly,
Allegedly. Okay.
allegedly.
So since you brought up the what the big boys,
Yeah,
thoughts on this Rocket Redfin deal and its impact on not just the industry, but again, where I always go, which is the consumer.
yeah. We'll see. So I think, it's interesting. I saw a number where, the combination of Rocket and Redfin, would touch 1 out of 6 consumers that have bought a home in the last year.
Wow.
So,
Wow.
too much of anything I don't think is good in our business. Concentrating in too much of anything is good in our business.
Yeah.
Look, Rocket wants to be Zillow. And, I think, there's they want to be known as a data and technology company, and they want to be all things housing. So, here's what I would say to that, and what I think about that is, and look, I am far removed from what you and Kevin and most of the other people on this call do every day. And way more than I do on how to, market and originate a loan. What I do think this is going to change the race to the consumer and how you get to the consumer first, because you got, the lender and you got Redfin, and how are you going to beat them, or how are you, the originator, going to win that race to the consumer? Because the game's changing. The game's been changing, and I think this accelerates the pace of change.
Yeah.
I think so too, but, and I've said this before, I have grave concerns around the idea that everybody is connected in a transaction. I think there is a lot to be said for independence, so that the consumer has somebody who's looking out for them going, you know what, this place is not worth what you're paying for it. Or, so you've got an appraiser.
Or look out, there's a whole problem with the basements in this neighborhood, or yeah.
Like there needs to be, and if you have everyone's that invested, that connected, it's all the same place. That doesn't happen. I mean, the meltdown was such a perfect example of this, where you had the realtors, the appraisers, and the lenders all working together, and that they were in cahoots. I mean, that was one thing, but that can happen so easily. You get the wrong combination of people, and they are not serving the consumer. And that is ultimately what I am always looking out for, is who's looking out for the little guy. I mean, all these companies just want to make more and more and more and more and more money. It drives me nuts. And when is enough enough? And it's never enough. That's what's happened in the mortgage industry. It's never enough. The earnings.
Well, the rate's never low enough either.
Oh God,
When
Kevin.
we had 2.5, they wanted 2 3/8.
I have been saying that ever since they started, oh, if the rates were just 6%, no, then they want 5, then they want 4. It doesn't matter what the freaking rates are. They want whatever's lower. So it's, yeah, I'm really concerned about that. And then I read this, that homeowners are frustrated that their commissions on the real estate transactions have not, taken a massive plunge since the NAR settlement went.
I had an interesting conversation with the real estate agent last night about that.
Tell me.
And then she was saying, yeah, they finally figured out that the higher the commission, the more money the house sells for.
Well, so this article cited a guy in Colorado who is frustrated because he wanted to negotiate a lower rate for his or commission rate, and the realtors weren't having it. He ended up selling the property on his own. What it does not say is what he sold it for and whether he got, you know what I mean?
I'm pretty sure I've always seen it. What I see from a buyer's point of view, if they say for sale by owner, they knock off the commission price.
That's right.
Off their offer price. And it's like, you didn't save anything. You could have been better off having someone working on your behalf, getting a commission for that work, and it's being paid by the buyer anyway. So who cares?
Yes. Yeah, exactly. So it again, when you're shopping for an attorney, when you're shopping for something else, I mean, are you in there telling them, oh, I'm on trial for murder, but I want to get I want somebody to renegotiate their rate down lower? I mean, it
Yeah.
doesn't make any sense. So it is, yeah,
I had this exact conversation also with someone else who was dealing with an immigration issue, and I was advising them on an immigration attorney, and they're like, "Well, I think we can do it ourselves." I'm like,
yeah,
"You really want that? That's a risk you want to take?
that right now.
It's for a marital visa, or what's it called?
Yeah.
Yeah, but yeah, they got married and they want to come bring the spouse to the country, and I'm like, you know, you're okay with the fact she might have to go back to her country, and you're gonna be commuting all the time. Not a great relationship there, but okay.
Putting people in the detention centers who have green cards right now. So, yeah,
Yeah, but they have to have done something. Okay, they're not just picking up green card people, are they?
hopefully they have done something. I'm hearing a few
Yes.
that's not the case. So anyway, so it is, yeah, it's something out there. So Dirk says, "Do you want higher rates, Audrey?" And I said it in that kind of voice because I know Dirk, and I would have been more belligerent should he be right in front of me. No, I don't want higher rates. Duh. I mean, obviously, I like it when the rates go down, but I also have been doing this for 375,000 years, and I know that every time the rates go down, they want them lower. That is a fact. A fact. So,
Did you see a second comment there?
no, what?
Working with a for sale by owners is negotiating with a fool.
Yeah, exactly. Exactly. So we have Ellen here who thinks I'm too hard on you, Kevin. What do you think about that? I mean, just because you're crying every time the show ends doesn't mean anything, okay? Oh God. Okay, so Bill,
Yes.
to us about production costs. I didn't give you this as something I wanted to cover, but it just popped into my little head. So we heard for a long time about how much it was costing to manufacture alone, right? Manufacturing costs, they'd gone through the roof. And they kept blaming it on LO comp, which is a bunch of hooey because I have not gotten a raise. As a matter of fact, I think I'm making less now per loan than I've ever made before. So with that being said, tell us about how that's going on the mortgage banking side of things, and are those costs moderating, coming down, going up? What's happening there?
So you know what? Um, the funny thing, the cost per loan, in my opinion, is the manufacturing cost per loan
Mhm.
is way more influenced by, are you doing a lot of production or are you doing a little production, not your actual costs themselves. I think the
Interesting.
costs have been relatively stable. I don't think that there's been some nirvana of technology that has been a breakthrough. It might be little small incremental things, but if your volume is high and you don't hire your staffing, at the same level of your production growth, your cost to produce is going to go down. Um, and if it's production goes down, and which, we've seen for a lot of the last couple of years, and your costs don't go down at the same or a greater level, then your cost to produce is going to go up. And so, in my opinion, it's been, the elusive nut to crack for our industry. Um, and I don't know that anybody is, that enamored with any technology that would do that. And I don't know that, because of all the downstream counterparties that our industry has, in the agencies and where the loans go after the agencies do them, that, some magic AI tool allows that. So, I think cost to produce is more based on your volume than it is your ability to reduce costs.
So
Interesting.
there are a lot of
Don't
things.
get more loans is what you're saying.
Yep.
Yeah, volume does fix a lot of things. That is correct for sure. I mean, there are also some things that we used to do that we don't do anymore. And so for instance, the work number or doing the automated VO,
Mhm,
right? So
mhm.
we used to, I mean, I started this business as a processor. I'd like print a VOE, I'd fax it, send it, courier pigeon, whatever, to HR somewhere. They weren't responding. I'd get on the phone, I'd make friends with the HR person, I'd get that thing done. Like it didn't cost the borrower anything for me to do that. And
Mhm.
I feel like, and then there are a lot of times where the work number does not supply the information that you need. Somebody has bonus or commission, you don't have the numbers that you need to calculate correctly for underwriting purposes, what that income looks like, right? So then you have to go and do all sorts of other gyrations, and you're also paying them, and you can't even get the information from them. So I feel like we've made some of these changes that are supposed to be better, and they're not, they're worse. And so it is interesting from our perspective on the ground, where again, if you're paying $56 for a credit report a few years ago and now you're paying 120, that's
36,
but
136.
Kevin and I were teaching an MLS class last year, and somebody said that they are disclosing $250 upfront on their LEs for credit reports and VOEs. $250
Yeah, you got to run them twice.
Can you imagine, like, what if your loan amount is $200,000 or God help you worse, lower, I mean. I mean,
Yeah,
those are egregious, crazy numbers, and the industry, it's become the industry standard, but you've got these people who don't ever touch a consumer and they just work in an office somewhere. They have no idea how that's impacting people. So I just find there's this disconnect. And then the technology, I mean, I've sat in meetings where like they give you 8 different amazing technology things that you could be using, and my brain explodes, before I get to number 2.5. And so, I feel like what has happened recently as the business slowed down and incomes have slowed down, to put it mildly, is there's been a pullback of some of the push for everything tech. And that's not been a bad thing. With that being said, there was a quote a couple weeks ago, AI won't take your job. The person who knows how to use AI will take your job. So I believe that. I believe that we have to know something about the technology. We have to use the good technology that's working. I mean, you know about this, Bill, as the head of a company. You know that you offer certain things, but the biggest thing is it has to be implemented, right?
Implemented and adopted. And, you can have all sorts of great things, but, most companies, you know, are can be hesitant to jam something down your throat.
yeah,
And so it's kind of one of those, you hope, if you build it, they will come, but they don't always come.
right.
And the other thing, there's, areas, and I have one in particular in mind that is increasing cost that isn't necessarily directly related to producing a loan, and that is cybersecurity. I think, there's been so much that's gone on the last couple years that just scared the bejesus out of all of us.
Yeah.
And,
And there have been companies that have disappeared out of the business because of cyber.
yeah, and you hear some of the horror stories from the bigger guys that have, been burned on that. And then,
Yeah,
you think of the companies, and some of the companies anyway that are represented on this call, it's like, Jesus, First American couldn't even invest enough to protect themselves. What the hell are we going to do? And so, and you don't roll over and not do anything, and that costs a lot of money.
Yep.
Um,
We've
and, you get burned. It's a huge financial risk, and it's a huge reputational risk.
yeah.
we've had the FBI on our show, and we've had we've done a number of cybersecurity shows
Good.
in the last year, and we've talked about this a lot. And Kevin, help me remember what the number is. When people are subject to some sort of breach or cybersecurity attack or ransom or whatever happens to them, what was the number that go out of business? It was like 65% of the
Something crazy. Well, the other one was how many people,
your reputation is totally burned at that point.
yeah, people that even pay for the ransomware never get the information back. It's gone, whether you paid or not.
Yeah.
And it used to be that there were some people known that if you paid them, they would at least give it to you back. But now it's like, no, it's such a small percentage to ever actually give you your data. So why would you even talk to these guys?
It is, yeah, it is, it
Well,
is.
to get them out of your system so you can resume business.
Yeah.
So you don't do it to get anything back. You do it to get them out of your system. So like you can now go back and resume business.
Yeah, exactly. We have a comment here from Lori who said, you must have tons of great real estate pros in your area, not worth too much in mine. 90% do almost nothing, so can't communicate their value. And I think that her comment is worth noting because there are, and not just, I mean, there are people in our industry, whether it's real estate or mortgage, that are not worth their commissions. They're really not. That is true. And I hope that they go away. I truly do. So with that being said, I think that realtors and lenders who are good at their job should work together and make sure that they are holding each other up and supporting each other so that we can be the best we can be for the consumer. And again, the borrower, the consumer, the seller, the buyer, that's what matters.
Yeah.
You know, and every time I hear, you know, somebody who owns a big company, except for you, Bill, of course, talk, it's all about money. You know, how much are they making? What's their bottom line? And Dirk made the comment, what was my time cost when I was a processor getting that VOE? Well, we charge a processing fee. So I got paid a salary. So I worked my tail off and I could make things happen. I would get deals closed because I could get a hold of someone in HR. And again, the borrowers' employers are buying into this idea that they're just going to pay the work number or whatever, or the borrowers did.
Well, say they didn't have as many people doing behind the scenes, having you call them and harass them all the time.
I mean, do you know, does the employer pay the work number also? Do you know that? Bill, do you know that? Or just the borrower? Bill, are you awake?
I am. I'm thinking. That's a great question. I don't believe we pay anything.
Okay, so just the borrowers are paying for this. So the employers decided their employees could bear the brunt of this. Okay. I mean, there you go. So someone made the comment or asked the question, what do you think is going to happen when student loans start reporting on April 1st for the first time since
It's actually a very interesting question because I wonder how many, first of all, are they going to start reporting and show all the people that had late payments in the last couple of years? Or are they only going to be going forward? So if you don't have a late payment between now and going forward, it's not going to show anything. And all the previous late payments are going to be mysteriously disappeared. Which is it?
No idea.
Yeah, I have no idea either.
Feels like a Jeopardy question.
Yeah.
What?
It feels like a
Jeopardy
Jeopardy question, and we all were stumped.
Well, I mean, okay, let me start with, I thought they started reporting the delinquencies on October 1st. I did not realize it was extended till April 1st. Did you?
I didn't either. I thought it was October 1st too.
Thanks for bringing our attention to that. Good Lord. It was like when I Googled, is the VA foreclosure moratorium still in effect? And it was after January, it was in January sometime. And it said, yes, it's still in effect. It will expire December 31st, 2024. And I'm like, wait a minute. Like,
Yeah.
hello. Anyway, so there you go. Let's see, what else do we have? Okay, I'm just trying to read this. And Bill makes us take all our trainings, or will lock us out of our access. I have no problem with that. Oh, so I think they're talking about whether we have to take the cybersecurity
Yeah.
online.
And if you skip it, you get locked out.
I wouldn't know.
A quick question. How many people do you lock out every year?
Yeah, that's a great
What
question.
percentage of your employees, you know?
I don't know. I got locked out.
Say he had someone take them for him, and at which point I'd have to reach through the screen and beat him. Okay, so let's talk about EPOs for a minute, because this is a subject that drives every LO crazy, because why we have to pay for them is ever.
Yeah. And why don't the banks have them?
But in this time where presumably, you know, if we look at the rates, they have been coming down, right? So you're in the middle of a transaction, you're locking your rate, and even my clients who I basically educate, don't even bring this up again. But when we're locking, you know, they'll say, so if the rates go down, then what happens? I'm like, you're making a commitment, so are they. this is your rate. I mean, unless it's some extreme situation. So, Bill, when we are in a rate environment that is going down, what is happening at the secondary level within our lock desks? And
So
how does that how are they managed?
I'm going to back up to a previous question. Our chief compliance officer just texted me and said 10% of our people get locked out.
Oh, geez, Louise, 10?
So yeah, 10%. So
Wow.
uh, so well, you know, and this is a
Thanks, Marty.
this is a timely question because
Thank
you
you.
know, if interest rates get below 6%, you know, and I know everybody wants to lower or whatever, but if it gets below 6%, after the originations that we've been doing above 6%, you know, in 22, 23, 24, 1 out of every 5 mortgages right now is above 6%. So you cross that threshold and you're going to have a number. So Audrey, is the question, why are LOs bearing the brunt of the EPO charge?
That's a secondary question. My real question is, how are you suggesting that we best navigate this? I'm being very careful about making sure that I'm locking in the lowest rate I can get. If I'm going to lenders who are going to give me a lower rate, so I have more, you know, like when the rates start to go down, it is less likely sooner rather than later that they're going to refinance, et cetera, right? So, you know, stay away from higher rate lenders at the moment, just because otherwise you're in jeopardy. But what else can we do? And
Well,
then secondarily, why in the hell do we have to pay for that crap?
yeah. So, you know, I'm not sure I have an answer to the first question. Back the last time I originated a loan in 94, I don't think there were EPOs. So,
I think there always were.
okay.
No.
So, you know, I'll tackle the second one first, and what I think many companies do, and I can't speak for many companies, but you know, if there were, you know, if there was $10,000 of revenue on a loan and the loan officer got 60% of it and the company got 40% of it, you know, and that the cost of the EPO gets split in a way that is commensurate or somewhat commensurate to, you know, how the revenue was earned at the time of origination. So, you know, a company is going to make, a loan officer is going to make 60% of it. The loan officer is going to pay 60% of what was charged as the EPO. I think is typically how most companies work.
It is, but it's still horse pucky, because if you are on trial and you are found guilty, you don't get a refund of your attorney's fees. We just closed a loan. We did all the work. We did our part. It is out of our hands. We didn't just refinance them. If we did, then yeah, sock it to them. It's fine. But
Maybe we have this debate offline.
maybe you
Not in front of everybody on that. So
maybe you could bring it up with NBA and they could maybe rethink this, because it's not fair at all.
look, I don't think you'll ever, and it's really not an NBA thing, I don't think you'll ever see a lender pay out a premium on a loan in order to lose it in a very short amount of time.
Well, we don't want that either, Bill.
And so if in fact someone were talked into, oh, don't have EPOs, don't charge back EPOs, it's horse hockey or whatever you said, you know, my answer would be, okay, I gotta pay a price somewhere. I've got to put it into my pricing somewhere. So you're, you know, be careful what you wish for, I guess would be my.
And Bill, Randy has the perfect, and we have said this a million times, have a 6 months prepay on a loan, period. Bring that up with have the trade groups deal with that. Bring it up with the GSEs. Don't shake your head, Kevin. I know that they don't like it. I know they don't want to do that, but it's really the only thing that's fair. Is if there is a prepay penalty, which is an EPO, and we're required to pay it, then the consumer should have to participate in it. And that will help them understand that they can't refinance willy-nilly. Now, if there was some extreme situation where for some reason they just bought a place, now they have to sell it or whatever. I mean, maybe there's some sort of way to minimize it for them, but knocking the LO for it versus the consumer who is doing it and the other people who got paid that they don't have, I mean, does escrow have to refund their money? No. Anyway, so there you go. Okay.
Well,
You're
and
always
the other
looking
part
out
of
for
it
the
though is,
consumer, aren't you? Like you said, you're always looking out for the consumer.
I am looking out for the consumer always.
Audrey, you know what you have to do? You have to go work for one of the big banks because they will allow their people to refinance again and again and again, 2 months after. I know someone who got a loan from the bank and then 45 days later, they were refinancing again, and 45 days later, they did it again. They never even made a mortgage payment for 4
Because
months.
it's staying with the same lender.
Yeah, same with the same lender.
And that, that's a different story. If it's staying with the same lender, they're simply replacing, you might be at a different or presumably a lower interest rate, but when it stays with the same lender, that then you're not going to get that charge.
You see this from Christina? I am paying an EPO to UWM and I was borrower paid and she paid off her loan cash she didn't refinance.
Mm.
Borrower paid and they charge an EPO. Are you
Well, but you would know, that's one of the things though, in defense of EPOs is the LO often knows that this is happening. I've had clients who said, oh yeah, I'm going to buy this other house. I'm going to sell this other house. Then I'm going to pay off the loan I just took off. Well, wait a minute. I'm out because
so
I'm going to get the early payoff.
Ellen's going to be very upset with me. Kevin, that is ridiculous. A lot of times they don't. So anyway, and yeah. So, and Christina's saying the follow-up to the UWM thing, the borrower knew and she didn't care. I mean, I had a borrower who oh my God, this boy, he loves to own his properties free and clear. So he did this purchase. I leveraged a primary residence and the place that he was buying as a second home. And I knew he was going to pay off at least one of them, like sooner rather than later. I told him, listen, here's your date. You got to make 6 payments. And God bless him, he did. Anyway, he was clearly nicer than this other lady that poor Christina was working with. I like how we filled up the rest of this thing with not a bunch of doom and gloom. So there's a couple quick things before we wrap up. Number one, I saw this little blip about the CFPB and their processing of complaints. So we've been very concerned about where does the borrower go if the CFPB is, been kneecapped. And this doesn't say what they're doing with them. It just says they're other than processing them. But there was an issue on February 10th. The CFPB was directed to halt all work. We knew that. On February 13th, the average complaint processing time jumped to 6 days. But by February 21st, the average amount of time it took the CFPB to process and complaints to companies returned to less than 1 day. So I am going to do a little better dive into how that's all working. And like maybe they're just processing the complaint, sending it to the lender, and nothing ever happens. I don't know, but maybe not. So
maybe they have AI doing the whole processing.
What?
Maybe AI is doing the entire processing thing. So they put the complaint in and then, off goes the system.
Maybe. Yeah. I mean, certainly possible, right? Certainly. Okay, there's one other thing I was going to say.
Speaking of which, I saw something very funny today. So here in San Francisco area, we have Waymo vehicles that are self-driving taxis. And I was watching, it was a narrow road, and I'm walking along it, and a Waymo is coming one way, and then a regular car is coming the other way. And the Waymo pulled into the side to allow the other car to pass. And the passing driver waved thank you to the Waymo vehicle. And I was just rolling laughing. It's like, you just said thank you to a car that can't see you saying thank you.
Thank you to Siri. I think like Siri does something for me. I always thank her. What? And I'm glad you're seeing Waymos do reasonable things versus the one I saw back up in the middle of nothing. I mean, for no apparent reason one day. Scared the crap out of me. So, all right, kiddies. With all that being said, tomorrow we'll have a full report on Jerome Powell's comments tomorrow. So that will be interesting. And
then we have a reminder, we have our event on Thursday on condos. If you're in the Bay Area, come over to San Francisco, Merced Boathouse, 6 o'clock to 8 o'clock, free for LOs if you sign up in advance.
And realtors. Yeah,
And realtors, yes.
because otherwise,
If you're a loan rep, you gotta pay.
yeah. And if you didn't sign up in advance, you better order a pizza to have it delivered there because there will be not enough food. And also, I just got a ping from Peaches, who's the head of the Ventura, Greater Ventura camp, and they are having an event on May 15th that at least one of us is doing a presentation at. I don't know about the other one.
Is that
So
you, Bill?
with all that being said, there are some things happening. Get out of your house. What'd you say, Kevin? I can go back and listen to this, don't try and hide anything. All right. With all that being said, Bill, thank you very much for being here.
Always a pleasure, Kevin and Audrey. Appreciate you guys.
Good seeing you, Bill.
Good.
We're
Keep
done.
up the good work.
Bye-bye.
All right.
Things done. All right. See you guys. Bye.